at the end of the presentations today, but meanwhile I'd like to invite Mark Hancock, one of the key members of our investment committee, to take the stage to give the market overview.
Good to be here, the 6th conference, which is great. I've been involved with Mark for nearly 20 years and it's really good to still be working with him. So Carl and I are on the investment committee and we're both speaking today. We've both got actuarial backgrounds, like all the senior leadership team at Berry. So, I mean, actuaries are kind of like engineers, and I don't know whether you call them structural engineers or mechanical engineers. Actually, Penny is a real engineer as well, aren't you? But it's like you've got about 10 engineers here who are all really professional engineers, and you're asking them to do some extensions or modifications on your house at Epping. You've got really competent people at a very professional level for that task, which is really good. So you probably have come thinking that I'm going to tell you some really great insights into where the share market's going over the next 12 or 18 months. And I don't really have a crystal ball, but I want to try and make some observations about what's been going on and where it might go to. Obviously, before we decide where we're going to, it's good to go back and look over the past to see where we've come from. And this is a simple chart that does that. If I show this one, it includes the impact of dividends. So what's this chart showing? The blue line is the US share market and the red line is the Australian market. And you can see that at the same starting point back in 2005, both markets got hit badly by the global financial crisis, and then the US market it more than halved as ours did, but then there's been a strong recovery path. And then from about here on, the last 3 or 4 years, the US market's taken away and surpassed us. One of the reasons that we've been held back is that we have a lot of mining companies in our index, and that's pulled back the average because there was a lull in mining at about that time. And also a big part of our index is the 4 banks, and having gone really well after the GFC, they've plateaued a bit lately. So really we want to know today, what I want to talk about is where are these blue and red lines going? If you can see on the average, the US market's done 8.9%, but that included this part where it was overvalued before the GFC. Now, if you take the last few years, the US market's gone up at over about 20% per annum. And since Trump got elected in November 16, there's been something like 100 record closing levels for the US market over the last couple of hundred days. So it's extremely optimistic in the US. And the reason for that optimism is that US economy's been very strong, corporates have been doing well, and inflation's relatively low, interest rates are low, so it's been cheap for corporates to borrow money. And obviously recently we've had US tax cuts announced by Trump, which has stimulated it further recently. So as we speak, the market's not exactly at the all-time record high, but it's only just off that high, and that was achieved in January. So I think we're currently we're about 4% below the all-time high at the moment, after that volatility recently. Is it possible the US market can keep going up at 20 to 25% indefinitely? Definitely not. There's one thing we kind of know, kind of like the laws of gravity, that prices can't keep going up at that rate. And they've been going up at that rate for about 4 or 5 years now. So there's this thing called mean reversion in finance theory, which basically says over time, markets must revert to an average level of performance. And it's hard to say whether the market might go up another 20 before it starts to revert, or whether that reversion could happen sooner. One of the main risks, you might say, that we've had recently is just risk of complacency. So many people have been investing in the market so successfully for a number of years that they just take favourable share market returns as a given, and they don't realise the inherent dangers. So markets that can go up 20% of the year can equally fall by 20% of the year. The other thing is that volatility was extremely low in 2017. So markets were almost going up on a daily basis and hardly ever falling in a very regular way. But we saw in February there was a sharp correction, and volatility started to increase a little bit. The number of ways of measuring exactly how elevated is that blue line, and one of those measures is by dividing the blue line by the earnings that the companies are generating. So you can get a PE chart. And at the moment that chart's quite elevated. There are a number of different ways of calculating it. A number of them are based on earnings forecasts going forward, and those earnings could prove somewhat over-optimistic. So there's a risk about those earnings that are in the ratio. The other thing that could be disturbing is the impact of disruption, and you will be aware there's all new companies starting up that are trying to disrupt traditional companies. So you would have read about Myer department stores having trouble because people are doing online shopping and no longer see the need to go to Myer. The offering's not compelling, and that applies in many other industries as well. For example, Tesla, the US company, is inventing the electric car and the battery to power it. But General Motors and Tesla, in my opinion, probably can't both be worth 50 to 60 billion US that the market's pricing in. In fact, personally, I think General Motors will end up probably beating Tesla and having a better car and a better battery. The other thing we have to understand is interest rates are very, very important to markets. Now, I've got it. This is kind of like the ultimate price of money. So this is the yield that you can earn on a 10-year bond invested in US Treasuries. So you can see that around the time of the GFC, yields were up around 4%. And then they got down to about 1.5%, not that long ago, even recently in 2016. And then there's been a sharp upward correction. We haven't got back to 4 yet, but we've almost hit 3. And this is unbelievably important for valuing companies. So in a sense, if you want to understand the value of a company, what the value of a company really represents is the value of all the future earnings that company is going to generate for shareholders, less the time value of the money that you'll have to wait to get those earnings produced. And this is the main determinant of the price of money. So it's the way we value those future earnings. So at the moment, over the last year, the market has been very optimistic about both the rate of growth of earnings, but also the fact that the interest rate, or the discount rate's going to be very attractive as well. But if roughly, ballpark terms, a 1% rise in interest rates could damage up to 10% of the value of a company's earnings. So if US Treasuries were to rise to 4% sharply, you couldn't rule out a sharp deterioration in the share market. The other thing that we haven't factored in is the exchange rate. I'll just come to that. Before I finish on interest rates, this is important. So the red line here represents the Australian cash rate, and the blue line is the US cash rate. So you can see that the blue line was almost zero for most of the time since the GFC. So the Federal Reserve was flooding the US economy with cash to try and thwart the recessionary impacts of the GFC. But Janet Yellen has been increasing the cash rates recently over the last 18 months. And it's quite interesting that as we speak, we've got pretty much the same cash rate in America as we have in Australia. We haven't seen the Reserve Bank increase interest rates here, although the banks have put up some of their mortgage interest rates, particularly on investor loans. Now, obviously, there's a meeting of the Federal Reserve expected on Thursday this week, which could see that little blue line actually surpass our red line for the first time, which very, very rarely happens. Now, that's got significant implications, possibly for the Australian dollar, because it's been a kind of free ride. If you were to take US dollars, instead of getting zero interest rates, to buy an Australian dollar and get at least that interest rate. So it's called a positive carry, positive return on that currency transaction. But if the currency return was going to be negative by buying Australian dollars, by giving up a higher yield in America and retaining a lower return in Australia, could have significant adverse implications for the Australian dollar. The Reserve Bank wouldn't worry about that. They'd actually be quite happy about that because they want to stimulate the economy, and a low dollar, although it reads like negative on the headlines, is actually very positive for exporters and for our terms of trade. So one thing that has been holding up the currency, and we're at about 78 cents at the moment, is that our iron ore and coal exports, which are so strong, the prices have been quite high recently. So China growth has been buoying our currency. But if the world was to get concerned about China and its growth rate, or its metal and steel utilisation, then that could really make the dollar even more wobbly. So I wouldn't rule out the currency going down to 70 cents or lower even over time. So if you were to ask me where to go more likely to 90 cents or 70 cents, I would say closer to 70 cents, but the currency is very, very hard to pick. I've got that exchange rate chart there. So you can see we're just hovering below the 80 cent level. Since the currency was deregulated in the early 80s, the average has been about 74 or 75 cents for most of that time. So we are just slightly above that long-term average. But the US economy is extremely strong, interest rates are rising there, so it is a question mark. Obviously a lot of Australian shares would benefit from a better US dollar. A number of our businesses have substantial US subsidiaries which operate there. So Brambles, CSL, Lend-Lease, Macquarie Group, etc. This is just a chart for interest to just highlight the differences in return between the different segments of the market. So the gold line represents the largest companies, the red line the mid caps, and the blue line the small caps. And Berry invests in a range of these different ones. So you can see that back to just before the GFC, the gold companies did probably the best in the early stage of recovery, but then the mid caps caught up, and the small companies don't look like they've done that well, but actually if you look over this very recent period, there has been a very sharp catch up. So what's basically happening is as the market sees that the gold and the red companies have been starting to be fully valued, they're searching harder and going down deeper into smaller companies to look for undervaluation. But generally there's no great bargains out there, but there are some good companies, and Berry's identified a really good portfolio of stocks to look at. I'm going to come back later and talk about the banks. But before we do that, this just highlights that resources were dragging back the index, but they haven't lately. This is a really good chart just to show you over the last 12 months, and this is up until just very recently, which is how the Berries company's gone. And I asked Anthony to pull out the best 5 and the worst 5 over the last 12 months. And you can see that the top 5 have been really spectacular, positive returns. Yeah, so Costa Group in particular was nearly 83%, and it looks like it's still going well. Tox Free was a company that Clark Beaton spoke on this time last year, and that's been taken over by another company, Cleanaway, at a large premium. So that's an incredible return over 12 months. Origin Energy, ironically, was our best company, wasn't it last year, Anthony? Yeah. So they've done very, very well, despite a fairly ordinary oil price, I might add. Then CSL's done well again, continues to do so well since it floated. Many of you would have had it from way back. And then Marco Corporate Travel, not that long ago, it's done very well already. On the downside, Woodside's suffering a little bit temporarily from a rights issue, but that should recover from that. Then the banks have been under pressure for a number of reasons, which I'll talk about later, but hardly a disaster. Ramsay Healthcare's had a few issues, and Telstra's been the worst stock, but it's obviously they cut their dividend, but we weren't overly exposed to Telstra, and it looks quite attractive now at these newer price points. So